Right, so welcome to lesson 2 of the investment appraisal, and we want to now look at the basic methods that are used for investment appraisal. Now, these basic methods are fundamental. 4 of them we'll be looking at in this lesson, and then in advanced financial management we'll be looking at other 4 in relation to that. Did I say 4? I think 3, other 3 in relation to that. So, before we get into the methods that we can use or the techniques we can use to appraise projects, let's catch up on some of the things that we have to look out for before then. Now, usually when companies undertake investment decision projects, there are a lot of benefits that they get. Apart from the cash flow benefit that the organization gets in relation to the maximization of the wealth of the shareholders, there are other benefits apart from the cash inflows or returns that the organization gets as a result of the investment. So we want to look at some types of the benefits that they can get. The first one is called savings, because assets used currently will no longer be used. The saving will include, so there will be savings in investment decisions when, for instance, an asset that is currently being used for something is not being used again, and we'll be making savings sometimes in staff cost. So, for instance, we are using a plant and machinery now, and it requires an additional factory hand of, let's say, 10 or 20 people. Let's say 20 people. Then we are bringing a state-of-the-art assets that will, or machinery that will now require only 2 people. So right now, we're going to be laying off the 18 people and save the company some amount of money there. Second is savings in other operating costs, such as consumable materials, electricity bills. That will be, because if we are bringing in advanced or state-of-the-art machinery, it is likely to be electricity efficient. That means that it's going to consume less electricity or power, and also takes shorter time to be able to produce our products in relation to that. Then, not even about the assets alone, extra savings or revenue benefit because of the improvement or enhancement that the investments may bring. Because we will be able to produce more goods, so there will be increase in sales revenue and additional contribution. There will be more efficient systems in operation, and there will be further savings in staff time. So what it means is that staff will now require less time to be able to work, because machine will be doing a lot of the job in relation to that. Possibly there are some one-off benefit that we can get where the company sells their existing assets. So if we buy a new asset for the same purpose, then the current or the existing asset that we are using would have to be sold off, all right, disposed of, so there will be revenue from the disposal of the current assets that are being used by the business. All these are some of the benefits that we receive, but there are some intangible benefits that will be able to come to the business. For instance, there will be greater customer satisfaction, because if we are using state-of-the-art computerized systems, then we'll be able to track our operations and everything with customers, so that as and when any problem arises, we'll be able to determine and know in relation to whether the company is satisfying its customers or not. Improve staff morale from working with higher quality machines. So the staff that will be retained from the usage or for the usage of the state-of-the-art equipment and machinery that a business currently uses, their morale will increase, because now they are using state-of-the-art equipment. So it is more or less like, first you're using, let's say, a machine that requires you to do a lot of carrying or requires you to do a lot of manual startup. But now you are using a machine that you just click or click a button, and then everything begins to operate, and literally everything is done helplessly. So you become motivated every day to work around the machine and also to learn more as an employee. And the third thing is that better decision may result from better information systems. So businesses will be able to make better decisions when they are using better information system in the organization as a result of the improvement in the process of the organization. Right. So these are what we have to understand in relation to the benefits that a company or companies enjoy as a result of their production or the investments in a project, or as a result of investment decisions. Now, when it comes to the appraisal of projects, there are very key things that we need to understand. That is that we need to distinguish between what we call relevant cost and irrelevant cost, or relevant cash flows and irrelevant cash flows. Now, the fact that we are doing investment appraisal does not mean that we are going to be taking into consideration all cash flows, all costs that a company incurs. So the general rule is that we are interested in all future incremental or extra cash flows to the company as a result of undertaking the investment. So the key word here is that we are interested in what? Future or incremental cash flow as a result of what? The investment decision that the company is going to be making. What it means is that if the cost is not incremental, if the cost is not an extra cost, if the cost is not an additional cost, if the cost doesn't relate to what we're going to be incurring in the future after the acceptance of the project, then that cost is not relevant and should not be included in our investment appraisal decision making. What does that mean? It means we are not interested in money already committed or cost already incurred, like sunk cost. For instance, if we have paid some research expenses for the projects to be, for information to be gathered about the projects, and we are now thinking whether we should accept or reject the project, that cost has been incurred. Whether we continue with the project or not, that cost cannot be what? Cannot affect us as an organization. So that is a sunk cost. So we are not interested in committed or sunk cost. 2, we are also not interested in historical cost. Like for instance, we are undertaking a project and we are using a machine that has been bought 5 years ago. Now, if you are undertaking a project using an equipment that has been bought 5 years ago, it means it is a sunk cost, it's a historical cost. We've already incurred the cost. So whether we undertake the decision or not, that cost will not change, will still remain the same because it is in the past. 3 is non-cash flows like depreciation, amortization, and those stuff. So we are not interested in those things. Depreciation, amortization, impairment of assets, we are not interested in those things because they are non-cash flows in relation to that. Then also some issues about provisions, okay? Provisions, we'll look at those things later on. We are also not interested in book values, and also we are not interested in the interest cost. So for instance, in the question, the examiner may say that a company goes to borrow money for the project, and the money that they are borrowing, every year they pay an interest of, let's say, $5,000. When we are appraising the project, we don't include that $5,000 payment as part of the cost of the project. Why? Because the cost of the borrowing, which is the cost of debt, will be taken care of by the weighted average cost of capital that we'll be using to actually discount the cash flow or appraise the project. So these are the cash flows that we are not interested in. First, money that is already committed. So committed cost, sunk cost, we are not interested in that. Historical cost, we are not interested in that. Non-cash flow items, depreciation, amortization, impairment of assets, we are not interested in that. Book values of assets, we are not interested in that. And then interest costs that we incur because of borrowing of finance to be able to finance the investment decision. Why? Because the cost would already have been taken care of, or would be taken care of in the KD, which will lead to our work later on. So we are interested in both direct and opportunity costs, opportunity cash costs and revenues. What does that mean by that? So we are interested in the incremental cost that we are going to be incurring, but we are also interested in the opportunity cost. What does that mean? If, for instance, we undertake those projects, and when we undertake those projects, we're going to need some labor that are currently working on a project which will earn the company a contribution of $5 per hour. So if we currently bring them to come on this project, that means that the company is going to be losing that contribution that is being earned on that project that is ongoing now. What that means is that when we undertake this decision, then we'll be losing that contribution. We will not be getting that contribution. And so that contribution becomes the opportunity cost for the investment project, the opportunity cost for the bringing of that staff to undertake this investment project. So we are not only interested in the direct money that we're going to be paying, but we are also interested in the money that we'll be losing as a result of the usage of resources that are currently earning money or contribution to the company. So this is a very key aspect that you need to understand. If we've already incurred the cost, we are not interested. But if we are going to be losing money as a result of the employment of the resources of the company that is currently being used to generate some contribution or to generate some revenues, then we would have to take that into consideration during our project appraisal. Other relevant costs that we have to consider include infrastructure costs, such as information technology communication system, marketing costs, that is the cost we're going to be incurring in the marketing of the product, human resource costs, the cost of labor and training of employees, as well as restructuring of the organization that is arising from the investment in relation to that. So these are the relevant and irrelevant costs that we have to take into consideration in project appraisal. Now, the reason why this is very important is that if you don't get this well, then you will not be able to get the right cash flows, then you will not be able to make the correct decision. So if we have already incurred the cost, we don't take it into consideration. We only look at it if it is an additional cost that we're going to be incurring or money that we'll be losing as a result of the making of that investment decision. Right, so now that we've got the basis right, now that we've got the principles clear, let's begin with a real journey now by looking at the basic investment appraisal techniques. So there are 4 investment appraisal techniques that are basic or fundamental that we need to look at. We have what we call the accounting rate of return, the payback period, the net present value, and then the internal rate of return. So we're going to be looking at them one after the other. So let's begin with the first one, the accounting rate of return. Now, the accounting rate of return is the idea behind it is that it expresses profit of a project as a percentage of capital outlays. So when we talk about accounting rate of return, what we are asking ourselves is, okay, what is the profit we are getting from the project as compared to the money we are investing into the project? So the ratio of the profit of the project to the capital outlay or initial cost of the project, it's what we refer to as well, the accounting rate of return. Now, the decision rule here is very important. The decision rule here is that if the accounting rate of return is greater than the company's weighted average cost of capital, or if you want cost of equity, then we accept the project. But if the accounting rate of return is less than the company's weighted average cost of capital of the company, then we reject the project. Remember what I told you about cost of capital. It is how much we need to earn, the minimum we need to earn, so that we can pay the people who are providing us with the finance. So if the rate is 20%, but our cost of capital is 25%, that means we are earning less than what we are going to be paying. So what do? We reject the project. But if the rate is 20% and our cost of capital is somewhere around 15%, coming, made a mistake there. If the rate is 25% here and our cost of capital is 20%, it means we'll be earning more, so we accept the project. But if our rate is 20 here and our cost of capital is 25%, it means this project is a loss-making project. It means it can't earn to even cover for our cost of capital, not to talk about maximizing the wealth of the shareholders. Now, there are 2 methods or approaches that can be used in the calculation of the accounting rate of return. So let me put them down and explain them briefly. So when we look at the accounting rate of return, we can calculate it using the formula average annual profit. Average annual profit divided by initial capital cost. Now when we say average annual profit, it's actually average annual profit after depreciation, okay? So this is like accounting profits. So an annual profit after depreciation divided by the initial cost. Or another formula we could use is accounting rate of return is equal to the average annual profit still after depreciation divided by the average investment. Usually in the exam hall, now note that these two formulas are all multiplied by 100 because we need to get our answers in percentages. Now note that in the exam hall, the examiner will prefer you to use the second formula in the calculation of the accounting rate of return. Alright, so we're going to be focusing more usually on the second formula. Now, when we talk about average investment simply means the initial cost plus working capital, if there is any, plus the scrap value of the assets divided by 2. This is very important. So the average investment simply means what is the initial cost we are incurring on the assets? What is the capital, working capital? That is the day-to-day maintenance of the asset. And then what is the scrap value? At the end of the economic useful life of the asset or at the end of the project, how much can we sell the asset for? We have to take that also into consideration if it is in the question. So we divide those by 2 and that gives us our average investment. So let's look at a question in relation to how this formula makes sense in practice. So if you look at your handouts, we have a question there. Congo Limited is considering the selection of one of a pair of mutually exclusive projects. Now before I get in, I should have told you, I think I've told you about mutually inclusive and mutually exclusive projects already, so you know what they are. I will not waste my time again. Congo Limited is considering the selection of one of a pair of mutually exclusive projects. Both would involve the purchases of machinery with a life of 5 years. So the two projects, all of them have a lifespan of 5 years. Project 1 will generate annual cash flows, that is receipts less payment of £200,000, and machinery will cost £556,000 with a scrap value of £56,000. Project 2 will generate annual cash flows of £500,000, and the machinery will cost £1,616,000 with a scrap value of £301,000. Congo uses the straight line method for providing depreciation and its cost of capital is 15%. Assume that annual cash flows arise on the anniversary of the initial outlay, that there will be no price change over the project's life, and that acceptance of one project will not alter the requirement amount or the required amount of working capital. Ignore taxation. Required. Use the above. Use the information to calculate or to confirm which project should be accepted or rejected. Right, so looking at this question, there are two projects. The examiner is saying that these projects are mutually exclusive projects, meaning that the acceptance of one project, it means we can choose to accept one and leave the other. So we are not actually under oath to take the two projects. So looking at the formula we put across, that the accounting rate of return is the average annual profit after depreciation divided by the average investment, let's look at how we go about the question. Remember, we are told that the project life for these two projects is 5 years. So let's begin with project 1. Now with the project 1, we have to first calculate the average annual profit that a project is making. So average annual profit. How do we get the average annual profit? We are told in the question that each year the company makes, or we expect a return of $200,000. So the annual profit, so before we come to average annual profit, we need to get what we call the annual profit. So the annual profit is going to be £200,000 times 5, and that is going to give us £1 million. That's 6 zeros, £1 million. Then we need to ask ourselves, remember, the accounting rate of return we are calculating is the average annual profit after depreciation. So if it is after depreciation, then we need to calculate depreciation because this annual profit excludes depreciation. How do we know that? Because we are told that this profit is receipt less payment. If receipt less payment, it means it hasn't taken into consideration depreciation yet. So if we look at the assets, we are told that the cost of the assets, so total depreciation, so this is not annual profit. I think that is an error there. So that will be a total profit for the 5 years. So let's look at total depreciation. Our total depreciation is going to be the cost of the assets. We are told in the question is 556,000 minus the depreciation, the scrap value of the asset. So we have the cost of the asset, we have the scrap value. So cost minus scrap value will give us the total depreciation over the 5 years. And the scrap value we are told is £56,000. It means the total depreciation on those assets is going to be £500,000. So if we have our total depreciation to be £500,000, we have our total profit to be £1 million, then we need to ask ourselves the total profit after depreciation. So profit after depreciation. So profit after depreciation is going to be the £1 million minus 0.5 million pound, and that will lead us to what? £500,000. So the total profit after depreciation on the asset is going to be £500,000. Now, after having the £500,000, remember what we are interested in is average annual profit. Average annual profit. This is the total profit after depreciation for the 5 years. So we need to now get the average of that, and the years is 5. So average annual profit will now be equal to the £500,000 divided by 5 years. So every year the annual profit is going to be £100,000. So this becomes our average annual profit after depreciation. Now that is the first slide. Okay, that's the first slide we need. The second slide is to now look at the denominator of the formula, which is the average investment, AI. Let me go to the shortcut, AI, average investment. And we said the average investment is the initial cost plus working capital plus scrap value divided by 2. Now, if we look at this question, we don't have working capital, but we have the cost of the machine and we have the scrap value of the machine. So we are told that the cost of the machine is £556,000, and then the scrap value is £56,000. So when we divide that by 2, our average investment is going to give us £306,000. So now we have our average annual profit after tax to be £100,000. Then we have our average investment to be £306,000. So what do we now do? We can now calculate our average, the accounting rate of return to be this, £100,000 over that, £306,000 times 100%. And that gives us an answer of 32.7%. So in relation to project 1, what we are seeing here is that we are told that the cost of capital of the business is 15%. So assuming it was this project, you could see that the accounting rate of return is way bigger than the company's cost of capital. So this very project will be accepted. Why? Because the accounting rate of return is greater than the cost of capital of the company. But we were not given only one project, we were given 2 projects. So using the same idea, let's go through the second project. So project 2. With a project 2, we are told that every year we make a return of £500,000. So that's 0.5 million pounds by 5, and that will give us 2.5 million pounds. And we are told in the question that the cost of this asset is £1,616,000 minus the scrap value of this asset is 301,000. So when we subtract the total depreciation on this asset is going to give us 131,500. So this is the total depreciation on the assets. Now the next step is to look out for the total profit after tax. So profit after tax. After depreciation, alright? So profit after depreciation will be the total profit, which is going to be 2,500,000 minus the total depreciation, which is 1,315,000. And so that will lead us to profit after tax of somewhere around, profit after depreciation of 118,500. That is 1,185,000. But that is just the total profit. We need to calculate the average annual profit. So we're going to divide that figure by 5. So 1,185,000 divided by 5, and that is going to give us 237,000. So the 237,000 becomes the average annual profit. The average annual profit. So after looking at the average annual profit, the next thing we look at is to look at the average investment. And so the average investment is where we ask, what is the cost of the asset? And we know it to be 1,616,000 plus the scrap value, which in this case is 301,000. So when we divide, we're going to get an average investment of 958,500 pounds. So now we can substitute these two and then get our answer. So when we substitute, it's going to be 237,000 pounds divided by 958,500 pounds times 100. And that is going to be 24.7 pounds. So if you look at this question, project 1, okay, is giving us an accounting rate of return of 32.7%. Project 2 is giving us accounting rate of return of 24.7%. But the company's cost of capital is 15%. So even though the 2 projects are all greater than the company's cost of capital, the question said we should advise the company which of the projects it should undertake. So we look at these two, we realize that the project 1 is bigger than what? Project 2. So since the rates for project 1 is bigger than project 2, we say that using the accounting rate of return, the company should undertake project 1 because its cost of capital is greater than the company's cost of capital and certainly greater than the accounting rate of return for projects too. So this is what you have to understand when we talk about the accounting rate of return. Very simple, down to earth. Make sure you get the illustrations right, that it is going to be the average annual profit after depreciation divided by average investment. In getting your average annual profit, three things. You need to get your total profits, you need to get your total depreciation, then you need to get your total profit after depreciation. Once you have that, you now can come and calculate the average annual profit after depreciation. So very, very important in relation to that. So 3 steps before you come to where you are, what you want to calculate, then certainly you can calculate the average returns in that case. So I'll see you in the next video where we talk about the payback period.